Dividend investing is at the core of my investing strategy. If you own a business, you want to receive a share of the profits from time to time from your investment. This is exactly what dividends are. Notice I didn't say all the profits are paid out, but some. Some of the profits are used to fund the growing business. Some are used to expand the business, and some is shared with the owners. A dividend in the Webster's Dictionary is defined as a share in a pro-rate distribution, as in profits, to shareholders. A lot of dividend naysayers out there say many of the same absurd things, like dividends keep the business from growing. That is assuming all of these businesses made good investments all the time. Dividends add to taxes. Well, that assumes what type of account you hold these dividends in. Another is that dividends reduce the value on a stock. On dividend day, sure, but high quality companies continue to increase in value, meaning you are getting not only a dividend paid, but share price appreciation over time. And those are just a few. Trust me, I hear them all the time. So today we are going to look at why the great Warren Buffett loves to invest in dividend paying stocks. If you're excited for today's video, then do me a huge favor. Click that link down below and let's get started. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your due diligence and do not take this as financial advice. And before we begin, here is a quick word from today's sponsor, which is MooMoo. MooMoo is a great platform for investors of all levels, and they have a lot of great tools that can be easily found on their mobile app. Right now, we are in the thick of earnings season, which is an important time for updates on particular stocks that you either own or might be interested in owning. On MooMoo, they have an earnings calendar that you may find useful, which you can find by going to the Markets tab down on the bottom and then Explore. And then you will see the earnings report, which if you click on, they will show many of the company earnings on that particular day and all throughout the week. A very useful tool. That's not even the best part. Right now, MooMoo is currently hosting a paper trading competition, offering a chance to win $1,500 in cash coupons and receive 1 month of Benzinga Pro for free. Additionally, new users who open an account, deposit on MooMoo, can receive up to 15 free stocks. Just use the link down in the description below. Now back to our video discussing why Warren Buffett loves investing in dividend stocks. As you are likely aware, Warren Buffett is the CEO of Berkshire Hathaway, a role he has held since 1965. Here's a look at the performance by year for Berkshire's equity portfolio. And on the right side, you can see the performance of the S&P 500 for comparative purposes. Since 1965, there are less than 20 instances in which the S&P 500 outperformed the Berkshire portfolio, which is quite a feat. After all, most individual investors, professional or not, fail to outperform the S&P 500 over the long term. Buffett and company have done exactly that. Since 1965, Berkshire has a compounded annual gain of nearly 20%, compared to the S&P 500 sitting right below 10%, so roughly doubling the performance of the S&P 500 every year. Berkshire has outperformed in 7 of the past 10 years compared to the S&P 500. Over the past 5 years, Berkshire has a CAGR of 10%, and over the past 10 years, a CAGR of 13%. Since 1965, the Berkshire portfolio has gained 3.7 million percentage points. Those are some massive gains. This means that if you invested just $1,000 into the Berkshire portfolio back in 1965, that $1,000 today would be worth $37.8 million. Had you invested that $1,000 in the S&P 500 at the same time, today it'd be worth less than $250,000. Those are some massive differences. Just proves that value investing, dividend investing, and if patient given the time, can be a very successful form of investing.
We look at it, the criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it means the earning power over the next 5 or 10 or 15 years is likely to be good and getting better or poor and getting worse. But we try to evaluate that future stream And then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated.
Warren Buffett, first and foremost, is what is called a value investor. He is looking for high-quality companies trading at a discount to their intrinsic value, and also businesses with wide moats. This means businesses with strong products that differentiate themselves and have competitive advantages to their peers. We will look at the top positions in a second, but think of companies like Apple, a premier technology company, or Coca-Cola, the largest beverage company operating within a duopoly with PepsiCo, as two examples. Diversification is often talked about as a key to safety when it comes to investing, as you do not want to have all your eggs in one basket. However, Warren Buffett and his good pal Charlie Munger have bucked this trend, as Apple accounts for roughly 40% of the entire Berkshire equity portfolio. Let's take a closer look at that portfolio, which we last saw an update in February. Hedge funds are required to file what is called a 13F filing, which shows their portfolio and the changes since the last quarter. So the February update that we got was as of 12/31. We will get our next update in May, which will be updated through Q1, which is March 31st. As of Q4, Berkshire had 49 holdings in its equity portfolio with nearly $300 billion in assets under management. The top 10 positions in Berkshire's portfolio include Apple, which accounts for 38.9% of the portfolio, Bank of America accounting for 11.2%, Chevron accounts for 9.8%, Coca-Cola 8.5%, American Express 7.5%, Kraft Heinz 4.4%, Occidental Petroleum 4.2%, Moody's accounts for 2.3%, Activision Blizzard 1.3%, and HP Inc. accounting for less than 1%. Over half the positions in the Berkshire portfolio pay a dividend, and several of them having yields of nearly 4% or more. However, the top 10 positions in the portfolio make up nearly 90% of the entire equity portfolio, and all 10 of these companies pay a dividend. Apple is the largest position, but they are not much of a dividend payer when it comes to yield, but they do grow their dividend near 10%. So the majority, the super majority at 90% of what Buffett and company invest in are dividend paying stocks. Dividend stocks are usually boring. They could be a boring form of investing. But as we saw from the performance since 1965, this boring method of investing has been outperforming the greater S&P 500 by a wide margin. Some may think it is boring, but I love seeing dividends hit my account each and every month. And you can follow along with my entire portfolio by subscribing to the Dividend Investor's Edge, where you'll also get 2 stock deep dives every single month, linked down in the description below. But let's next look at how much Berkshire earns in estimated dividend income from just his top 5 positions. Chevron is the company's biggest dividend haul, bringing in an estimated $1.01 billion in dividend income over the next 12 months. They have a dividend yield of 3.6%, and they have paid growing dividends for 36 consecutive years. Occidental Petroleum, OXY, Berkshire owns $10 billion in preferred shares as well, which yield upwards of 8%. In total, Berkshire will receive $952 million from Oxy in terms of dividend income over the next 12 months. Bank of America is next on our list, where Berkshire is expected over the next 12 months to receive roughly $909 billion. The banking sector has gone through a mini crisis of sorts, and Buffett has long loved the financial sector. But since this mini crisis, he has dumped a lot of his regional banks, but sticking with Bank of America, praising their strong leadership over the years. Bank of America currently has a dividend yield slightly under 3%, but they have a 5-year dividend growth rate of 15%, and they have increased their dividend for 9 consecutive years. The 4th largest dividend payer in terms of dividend income is our number 1 position, which is Apple. They account, as we saw, for nearly 40% of the entire equity portfolio. This right here should tell you how low of a yield this company pays. Apple's expected to pay Berkshire $842 million over the next 12 months. They currently pay a dividend yield of 0.6%, have a 5-year dividend growth rate of 8%, and they have increased their dividend for 9 consecutive years and counting. Fifth on this list in terms of dividend income is Coca-Cola, a longtime Warren Buffett favorite. Not only does he love the stock, but he loves and uses the product regularly. Berkshire is expected to receive $736 million in terms of dividend income over the next 12 months. Coca-Cola pays a dividend yield of 2.9%. They have a 5-year dividend growth rate of 3.5%, and they have paid a growing dividend for 60 consecutive years and counting. Now, all of these figures are subject to change based on dividend hikes or Buffett adding or trimming any of these positions. In 2023 overall, Berkshire is expected to receive $6.1 billion in annual dividend income from its equity portfolio. When it comes to buying stocks, Buffett does not intentionally target dividend stocks, instead focusing on the wide moat businesses. The other keys to his success is patience, something he speaks to a lot. Buying when others are fearful, or buying a wonderful company at a decent price rather than a decent company at a wonderful price. He utilizes what I often refer to as the dividend snowball strategy, taking dividend payments to add even more shares to your portfolio. As time goes on, that dividend becomes bigger and bigger. Berkshire owns many companies outside of just the equity portfolio where you see public companies, which you can find on their website. He is always looking for ways to increase the company's cash flow, and that is what draws him to dividend stocks, is that consistent and growing cash flow. That wraps up our video today on why Warren Buffett loves to invest in dividend-paying stocks. If you enjoyed this video and enjoy the content, make sure you subscribe to the channel. Make sure you hit that like button. And with that being said, we'll see you in the next video. Take care.